Hi everyone, and welcome to this special webinar. It's the InvestSMART portfolios, and we're also going to look at the mind games of investing that go along with it. I'm Tom Wilson. I'm the investor education specialist at InvestSMART, and I'm joined by the head of portfolio services, Mitchell Snedden.
Thanks, Tom.
Thanks for coming in. We've got a number of different slides to get through, covering off a number of different topics. Basically, how it will run is we'll go through the portfolio performance first, and we'll take you through some of the mind games and some of the solutions. There is a question and answer element to this as well, and we'll keep that to the very end. So we've got a number of questions from the registration process, but as we go, you can definitely pop them into the right-hand side of the screen, and we'll see them, and we'll do our very best to answer as many as we can in this short period. We're going to try and keep it a bit more fast and punchy, not too much waffle to slow down everyone. But the other thing we have to point out is that we provide general product advice only, not any type of personal financial advice, as per the disclaimer there on the screen. But Mitchell, over to you to look at the performance.
Thanks, Tom. So what we're looking at here is the InvestSMART professionally managed account performance for the last 12 months up to the end of May. So I thought this was really important to put this up, just to give everyone a bit of perspective as to the long-term returns. If you're like me and you do look at markets on a short-term basis, as in like I look at them every single day, I'm reading the news just like everyone else. So I'm talking internally with our own team about what we're seeing happening. We're talking with clients, and of course we're on social media, which brings its own pitfalls. You do get bogged down in that real short-termism, and it's hard to take a step back and see the forest for the trees. So I thought it's important just to have a step back and look at our core diversified portfolios here and look at how they have performed. So if you are only getting your news from the mainstream media, from social media, it may come a bit of a surprise to you that our portfolios are all in the positive territory, and considerably so. So for example, I'm looking at the InvestSMART high growth portfolio there over the last 12 months, 5.97% after fees. The growth 3.93%, the balanced 3.08%, and then the conservative 1.47% over the last 12 months. So all of them in positive territory there. But if you were to only go off the media and what you're reading on social media, you'd probably be expecting to see those numbers in quite negative territory, because all the rhetoric out there has been incredibly negative. Of course, I look at the questions that have been pre-submitted from everyone, and you know, it's very much dwelling on the big headlines out there that are predominantly negative, being inflation, being increasing interest rates. You know, what effect do they have on dividends? What we've seen happen with bonds over the last couple of years as well. So all of these negative sentiments out there, but I think it's just really important to sit back and see, you know, that we actually have had a positive 12 months across all of our portfolios. Now, I do want to jump down, if you go to the next slide there, Tom, into the actual ETFs themselves. So these are the main ETFs that make up our conservative, balanced growth and high growth portfolio. So all of these ETFs come together in those four portfolios, and they're blended in, and they're just blended differently. So they all hold the same, but of course in your growth and high growth, you're seeing far more Australian share exposure, and you're seeing far more international share exposure, and less of those defensive asset classes like bonds and bonds and cash. Now, when we go down to balanced and conservative, you're seeing bonds in that reversed, and you're seeing bonds and cash make up a larger percentage of those portfolios. And so here, what we're seeing is just how these diversified portfolios have come together, how the returns have come together. It might surprise people, but looking at something like, say, fixed interest and the iShares core composite bond ETF that is held throughout all of our portfolios, that's had a positive year of 1.6%. The infrastructure assets in the VanEck Global Infrastructure ETF, they've actually been the most negative performing. There's a couple of reasons for that, and that's because of the re-rating of the valuation of these infrastructure assets with the increase in interest rates, as well as cost blowouts when it comes to the infrastructure, the budgets and the contracts that these people are working towards, and they're mostly related to COVID. But what really stood out to me is the international share component really has carried the load, so to speak, recently. 13.48% to the end of May. With that, you're seeing a couple of things. You're seeing the AI revolution in the S&P 500 driving the US market. You're seeing Europe do better than expected. You are seeing Japan, which makes up about 6% of that ETF. You're seeing Japan absolutely flying, I believe, and don't quote me on this number, but I believe it's about 29% in the last 6 months. Japan has been absolutely on a tear. And of course, you do have currency movement there as well, adding to that return. So this slide here shows me the importance of a diversified portfolio. So blending, I can't sit here and tell you which one of these ETFs is going to do the best in the next 12 months. But what I can say to you is by blending these through in a risk in line with our risk profiles, you're going to get a decent risk-adjusted return, and which is what we're trying to do in our portfolios. Now, I know we've got a lot of clients sitting on this webinar. We've got a lot of people who are taking a look at the InvestSMART portfolios. But I know here at InvestSMART, in our InvestSMART portfolio manager, the people who use that service, most of them are actually underweight international shares. And so this really does highlight the opportunity that they're missing out on through that lack of diversification across the global equities. So let's jump on down to our next slide here. So what I wanted to, and this kind of plays into a bit of what Tom's going to be talking about as well. What I want to show people here is this is using our InvestSMART growth portfolio. It is the long-term returns, and where next year we'll be hitting 10 years for this portfolio. So I've highlighted the most recent peak in this portfolio, and that's December 2021. Now, we had a lot of accounts open in the year of 2021. It was a really good year for markets in general, a really good year for us as a business with how many new clients came on board. But for those clients, they've experienced probably not the best time as far as returns go, because as we see there, December 2021 was the peak, and it's pulled back since then. But this is going to come into something that I'm going to talk about shortly. You can see multiple peaks and troughs throughout the time frame of this portfolio. You've got years like January 2016, you've got July 18, and then of course January 2020. These were all peaks that we experienced in these portfolios over the long run. And now, if anyone had come into our portfolios at those points in time, they too would have been hit with that negative short-term experience. Now, there would have been a lot of emotions and a lot of psychological biases at play for those people, looking to, potentially impacting their portfolio and their returns. I know we did lose some clients that came in 2020.
Around December-ish.
The market was really flying in December.
Here.
Yeah, we did get a lot of new accounts in there, and some of them did fall into these pitfalls of panicking when COVID hit, and we saw that steep decline in markets. Now, of course, hindsight, we do know if only they had held on, they would have not only regained any lost momentum, but they would have gone on to hit new highs as well. So I know Tom's going to be talking about that a lot. So I just wanted to just to highlight it that these times of uncertainty have happened in the past. I've never not known a time in markets where things haven't been uncertain. There's always something to worry about. down the
always
track.
uncertainty, isn't there?
That's right. And be it, you know, who's maybe sitting in the Oval Office. I know when Trump became president, there was a lot of talk in the market about whether or not it was a positive or a negative for global share markets. In the end, like a lot of these things, it didn't really matter, and the world moved on. So you can see, if we jump forward to the next slide, our portfolios, those investors who did come in, you know, they're now all creeping up to almost being in positive territory. But of course, as well, our portfolios are designed for the long term, and so none of those periods that we looked at there, be it in June 16, January 2020, no, it took maybe 18 months max to recover to their previous peaks. Now, all of our portfolios, and I know our clients come in to invest with us with the absolute best intentions, all of our portfolios have a minimum investment time recommendation, and absolutely every single one of them are longer than 18 months. They're, even the conservative portfolio has a minimum investment time frame of 2 years. So if you're coming along to these portfolios, be prepared to follow that time recommendation, and be prepared to follow your original plan. I'm sure you didn't come along to investment markets with an 18-month time frame in mind. You came with a 5, 10, 15, 20-year investment time frame ahead of you. And so Tom's going to give you a few tips and tricks to help you keep that in mind and keep focused on that investment time frame. Now, just onto the next slide. This is really quickly something to keep in your back pocket as well, to help you keep on track with the investment timeframes. This is a chart dating back to 1972. It's the MSCI World Equity Mid and Large Cap Total Return data. And so that basically is every single stock in the developed world taken into consideration here. And it's showing you your chance of having a positive investment experience or a positive investment return based on your investment time frame, so how long you stay invested for. And so you can see the longer your investment time frame, the greater the chances of you having a positive investment experience. Now, if you're only investing for 1 year, like a 12-month investment time frame, that's a 50-50 chance of having a negative or a positive experience. You're rolling the dice. But as soon as we go out and say go to 4 years, which is what, which I know there's only one of our portfolios that has a recommended investment time frame of less than 4 years. So basically every single other portfolio of ours, and I'm sure a lot of your investment plans are longer than 4 years. If you go out to 4 years, you're almost sitting there at a 90% chance of having a positive investment experience. So, so just think about that. That's something that's 100% in your control, how long you choose to invest for. Now, on to my last slide, and I know there was a lot of questions that came through about the economic outlook. I personally take the Howard Marks, who's a very famous American investor, approach to macroeconomic news, whereas I don't put a lot of value on those forecasts. The reason for that is macroeconomics is something that's completely outside of my control. I can't control what central banks do. I can't control what governments do. I can't control, you know, what wars are going to be happening around the world. 100% out of my control. And so I try to focus on what I can control, and that's my diversification, my investment time frame, how much I'm paying. So my brokerage or my management fees. That's what I look at, and that's what I focus on. But I do understand that right now the macroeconomic news is at the forefront of everyone's minds, more so than ever, and they might not even know that that macroeconomic news is on the forefront of their minds with interest rates, for example. You've got a lot of people on the street talking about them who normally wouldn't. So I reached out to two people who know a lot more about the macroeconomic situation than myself. That's Callum Pickering Long-term Eureka Report members might remember Callum. He used to write a lot of economic articles for us. But Callum Pickering is the senior economist now for the Asia Pacific region of Indeed Group. Now, Indeed Group is the largest jobs website in the entire world. So think of it as a Seek on steroids. So he's got a lot of access to labour market data and job seeker data globally. And then I reached out as well to our own Evan Lucas. Now, what came out of my chat with Callum, and this is erring on the, are we going into a recession? Are we not going into a recession? He said, right now, our labour market is incredibly strong. And he's seen no spike in unemployment. And he did say, look, there's a fair chance we could go into a recession, or at least a technical recession, which is 2 quarters in a row of negative growth. He said, if we are going to be heading into a recession, going into one with a really, really strong labour market is the best position we could actually hope to be in, to go into one. And we'll be poised to come out the other side of it quite strongly. Now, talking with Evan, he's been talking about the recession being more of a pullback in consumer spending. So it's I can't remember the term he specifically used now, but essentially it'd be a pullback in people, like, you know, instead of more consumer discretionary, travel, etc. So instead of going on an international holiday, people might take a domestic holiday, and they may cut out that holiday altogether. Their basket size will shrink at places like Coles and Woolworths, and they will forego a lot of those luxuries.
Yeah.
So now there was a couple of questions that come through. Now, based on that, what's the impact of dividends and income if we do go through something like this? Now, looking at our lens of a diversified portfolio talking with Evan, he doesn't really see too much of a dip at all in the dividends to our diversified portfolios. Yes, we could see a pullback in the Australian ASX 200 dividend yield, maybe the VGS, which is the international ETF that we hold. But he did mention as well, you know, we're looking at the banks, which are a very large component of the dividend from the ASX 200. Their margins have never been fatter with the interest rate increase. So and of course the dividends, a decline that we may see in the ASX 200 and that Australian share component is well and truly offset by the increase in the yield that we're getting on our cash in the portfolio and the increase in the yield that we're getting on our bonds in the portfolio. So once again, kind of shows you that the diversification across the portfolios is certainly helping us weather the current situation that everyone is experiencing. Now, both Callum and Evan did reiterate, someone's asked here, you know, what is the long-term outlook? Like, how long would we see a recession going for? Also, what is the long-term outlook on interest rates? Short-term, they both agreed that, and especially because we had some strong jobs data come out yesterday, that interest rates in the short term are more likely to go up, to increase, but long term, they actually expect them to come down. So long term, they're talking about next year. They're looking for those interest rates to come down, simply because there's so much debt in the household sector that it would put maintaining the interest rates where we currently are would put a real strain on households. You can cope with it for a while, but after too long, it will buckle households. So they're expecting those interest rates to come back down towards a more neutral setting. Well, when we say neutral, we mean they're not stimulatory or contracting, and you're looking there at anywhere from 2 to 3%, the RBA cash rate. So even though we don't talk too much about macroeconomics here with our portfolios, because we are diversified and we understand these macroeconomic headwinds are always going to be there. It is right now, I understand, in the context of our own lives, important to have a bit of a look, but also keep it into perspective, and it doesn't change our investment patterns, doesn't change our investment time frame, doesn't change our asset classes either that we're exposed to. Now, what I'll do now is pass over to Tom. I've spoken about all those things that we do worry about, and also how we've had a look back at those charts at the cycles of the market that we go through. I know from our conversations, Tom, there's probably there's a few people out there, you know, maybe struggling to see a clear future and stick to their investment plan. So let's talk about some of the biases that are impacting these people and what they can do about it.
Yeah, absolutely. And even that point you were talking about with it being cyclical and also putting it into context. So at the moment with high interest rates, a lot of self-funded retirees who are relying upon income streams that are generated from fixed interest or fixed income are very happy. So they say this is fantastic. But then you go back to during COVID, where we had interest rates at record lows. They were the ones that were upset at that period.
Yeah, I remember taking many calls from people who were getting out of their term deposits because they were getting 1% on a term deposit, and they couldn't live off that. So they were jumping up the risk curve and going into balanced, conservative, or even growth portfolios, and taking on that additional risk to get that additional income.
Yeah. And there's a question that we got here that we'll look at a little bit later, but it's literally the carbon copy opposite of the question we were getting during that period. But first of all, I'll talk about some exciting stuff. And these are a lot of the biases that we see. We may not be aware of them, but it's good to at least put a name to them so we can identify them. There's a course that we run at InvestSMART called Bootcamp, and we actually have a whole section that's dedicated to investor psychology. We'll have a look at the anchoring first. Basically, we'll use the example of the $100 anchor. So imagine buying a stock at $100 and it drops down to 80, and you sit there, you're all anxious, you're waiting for it to return to that $100 mark. So that's anchoring. You can sometimes withdraw all your funds far too early because of that during market volatility. So basically, to overcome it, try not to let those past prices weigh you down. Focus on future potential, not past costs. Remember, the long-term market trend is your friend in the investment sea. And so what we mean by that is that you might have in your head that $100 mark, you have to get back there in order to make everything right again. And that's just not the right way to look at it. You've reframed it and you've anchored yourself on that $100 original purchase price. But the market might have changed, and you know that there's a temporary dip in markets, but as long as you stay on track with your plan, you might find that over time, in the long run, it'll go to the 100 and go past that. So that 100 just becomes a number. It's not something you should become too fixated on. But unfortunately, with this bias that we all have, we do anchor to certain prices. So InvestSMART can help investment planning. That's one of the most important things. If I was to sum up the secret, the content to the InvestSMART Bootcamp course and save you having to do it, literally do an investment plan. So have a goal or multiple goals, timeframes to reach that goal, and understand your risk tolerance, your risk profile. But we take you through step by step over a period of 3 months you've got access for. We also make a point of just letting you know that during times of volatility, you might not be in the same mind as when you entered your investment. So doing the investment plan when you've got a rational mind is the best way to go about it, because you can refer back to a period when you were thinking a lot clearer. The herding. Everyone's probably got an example of this, and you can see the Bitcoin photo there, so you probably know where I'm going to talk. It's basically the trendy crypto cliff is an example. Ever jumped onto the Bitcoin bandwagon just because everyone else was doing it? That's herding. So it can lead to selecting investments based on trends rather than your personal financial goals. And I know myself, I speak to a lot of friends and even family who usually come to me hopefully before they say jump on one of these bandwagons. They might say something like, Tom, Bitcoin looks amazing. It went up, 200% last year. It's going to do the same, isn't it? Should I put everything I've got into it? And of course, my general advice is always, look at something diversified, match it to your goals, your time frame, and your risk tolerance, risk profile.
And as well, I think here, herding effect can definitely have people jumping into asset classes or investments that they just don't understand.
Absolutely.
I had a lot of friends getting into cryptocurrencies. For one, I personally couldn't wrap my head around the functionality of them, couldn't wrap my head around the value of them, or the necessity for them, even though I was told I was wrong by numerous crypto fanatics. So I just stayed well and truly away from it. So, but the same goes for yourself as well, like jumping into individual stocks. I remember,
yes, yep.
A positive story of a herding effect into stocks was people jumping into Afterpay, for example. That is a success story. There's many more stories that don't end so successfully. So just understand what you're jumping into before following the crowd.
Absolutely, and that's, I guess, the best way to overcome it is to break free from the herd by understanding the market's emotional cycle. And there's this brilliant chart, like a roller coaster of emotions. If you Google it, just type in roller coaster of emotions investing, and you'll see that. Trusting your own analysis and your chosen path. So we're not saying you need to go out there and pick certain stocks. If you get a diversified portfolio, for example, you might have seen how Mitchell ran through the different ETFs we hold. We even ourselves at InvestSMART, when we want exposure to the Australian market, we'll just choose one ETF that has the top 200 Aussie shares by its market size, market capitalization. And then we do that again for each asset class. So basically, InvestSMART can help with this with diversification. Our portfolio spread the investments across different asset classes, helping you to balance your risk and the perils of investment funds.
I would also add to this as well how you can help yourself if you're sitting back going, yeah, I did jump into the market when all my friends were, and now I'm wondering, what do I do? Your time frame. Time is your best friend. If you're in a diversified portfolio, even just in a single asset class ETF like the ASX 200 or an international one, if we go back to that chart showing your the chances of positive returns over the long term, just hold on and stick to the recommended time frame of that investment product if you can. That will overcome that initial herding bias mistake that you may have made.
And with outcome bias, I think this picture pretty much summarizes you and I on a Friday night. Not at the casino, of course, but so basically, have you ever gambled on a hot stock tip and it's paid off, making you think it was a wise decision? Well, that's outcome bias. So it can lead to overconfidence and risky investment decisions. So basically what's happening there is that you might make a very risky decision and it does work out, and down the path you think in hindsight, oh gee, that was pretty good. I should do more of that. You can overcome it by turning the tables on outcome bias by focusing on the quality of the decision, not just the outcome. So you're asking yourself, why would someone else see this as an opportunity? So basically questioning that process. InvestSMART has bootcamp, which we really do try and take you through a very structured approach to this. It comes down again to, even when you're setting up your investment plan on a piece of paper, an Excel spreadsheet, going through and asking yourself various questions such as, what would I do if the market did drop 20%? Would I just cut and run, close out at the very bottom, and not let the time frame allow itself its full time to run? What would I do if this happened? What do I do if I can't, suddenly had to stop working? Would I close everything, or would I readjust my portfolio to something a little bit down the risk ladder?
Yeah, so the outcome bias is something that we I'm going to go back to talking about 2021. A lot of investors, there's a couple of biases at play here, jumped in onto the investment bandwagon. Stock markets were going crazy. Everyone was happy, your Uber driver was talking about talking about investing, et cetera, et cetera. And so you've got the herding bias coming in there. And then when the markets dipped and declined from December onwards, people are sitting there going, well, I've made a mistake.
Yep.
And that's the outcome bias. You're judging your decision based on that outcome rather than the steps and the processes you made to come to that investment decision in the first place. Now, with the outcome bias, a great way to avoid it is to just sit there and go, well, knowing that a decline in markets is something that absolutely can happen, and sticking to your plan. Your plan might have been, I'm going to invest for the next 7, 8, or 9 years, and I'm going to add $100 a month, every single month for that time period. If you stick to that plan, I'm very certain you're going to have a positive investment experience. So don't judge that your initial decision, which was a positive decision, by those short-term results.
Yeah, so we can be very critical about ourselves when we make mistakes, but yeah, sometimes it's not fair. We're not fair on ourselves, and that's why these are biases that we can at least identify them and overcome them, and hopefully, let everything then work for us. So. That's covered off the content. Definitely pop in questions. You can do that on the right-hand side of the screen. So if you've seen anything there that interests you and you want more information or you want us to explain it more, this is the opportunity to do that.
Yeah, whilst we're waiting for any to come through, there were some questions that were sent through prior to today's presentation. I believe I covered off a little bit of it, but there's a couple that I just want to extrapolate on. A couple of people asked about the role of bonds in a diversified portfolio. Now, I know for people who have held bonds over the last 24 months, it's been a painful experience as these interest rates have ratcheted up. Of course, the face value of those bonds have declined. Positively, though, for bond holders, the yield of those bonds has increased. Now, what we have seen over the last 24 months was a once in a lifetime kind of incident for bonds. This is very unusual for them to experience what they've been through. And so for the role of bonds in a portfolio, do they still have one, especially in our diversified portfolios? Absolutely. We do think they have them right now. They're giving us enhanced yield. But as well, they're still providing that ballast in that portfolio as a defensive asset. If you think about what we've seen bonds go through, they essentially went through like a GFC-ish event of their own. But what they declined by was about 8 to 9, 10%. When equities go through something like that, you see 20, 30% wiped off the value of equities. So they still do provide that defensive aspect for a portfolio, and they're providing that enhanced yield. So absolutely, they have a part to play in our diversified portfolios. And as well, as we touched on, we don't know when the which asset class is going to be outperforming for the next 12 months, the next 24 months, or the next 7 years. But having a good blend of those, we're going to capture a bit of everything in a diversified manner. Now,
I was going to point out too, I'm just showing there's a really good article that Philip Bish wrote for us, and it's talking about 2 of the actual ETFs that we use that hold bonds, and he actually got into contact with Vanek, and also
that's a different article.
And that's a different article. So it's not this one. He's written a couple of articles.
But if you click on Phil Bish's name, and what you'll do is bring up every single article by Phil, and you'll see that he's got those the bond articles in there. There it is.
Why bond ETF distributions bounce around?
Yeah,
like
and
me.
Like you bounce around. Phil reached out to Vanguard and iShares for this article, and got a good little deep dive into this. And also, if you want to learn a bit more about these investor biases and maybe get a little bit of a taste of boot camp, I know Phil's written a lot of articles on these very biases, the herding bias, the outcome bias, etc. So do you have some questions there, Tom?
Yeah, James has asked one here. Thanks, James. And it is, why isn't the InvestSMART international equities shown in the performance table?
Because I just focused there on our core diversified portfolios. I could have put absolutely every single one of them up. Just would have made for a bit of a busy table. If you hover over investment portfolios up the top there, Tom, and on the right-hand side, you've got the international equities. We can actually see, I'd say the international equities would have been our best performing portfolio. If we go and turn that into a table. There you go. So 1 year, the total return almost 12%. So very much in line with VGS there. Yeah. So sorry, it was just a keeping a tidy table rather than deliberately omitting it.
Yeah. There's another one here from David Vernon saying, what has the driver been for ethical growth? Doing better than the vanilla growth fund. So I guess it comes back to having to, looking at, again, we probably didn't have, well, we did, didn't we, on the actual slide?
Yeah, we had the ethical growth portfolio up there. And I was going to say it's, right, so yeah, ethical growth there. Looking into, I'd have to actually, David, look into the specific ETFs there. Off the top of my head, though, I believe if you look at an ethical portfolio in general, what you are underweight significantly is materials and resources, and like alcohol, tobacco, gambling, etc. So you're underweight those asset classes, and you are significantly overweight, comparatively speaking, in technology. So if you look at an and so what we've seen run pretty hard recently, a lot of the international tech stocks like Google and Microsoft on the back of AI. So I will have a look into this a bit more deeply after the webinar and email you if I'm incorrect. But I would say it's that overweight to tech and healthcare. Tech, healthcare, and financials is what the ethical will be overweight, and that I presume will make that difference.
There was one of the questions that I was referring to before, and it was from Daniel, just talking about, in the growth portfolio, and I might just go to the actual web page again just to show you, because Daniel was just asking, and we could literally take this question and flip it. We were getting asked this during the COVID pandemic. The question Daniel has is, growth portfolio, your low cash and high international exposure, is of concern. Would you pivot this to be more cash in the future? So we'll have a quick look at I'm going to the growth portfolio here. I'll scroll down to key facts, asset allocations and holdings, and you can see the cash is around about 13.5%, and that goes into this ETF here on the side called the Better Shares Australian High Interest Cash. AAA is the ticker, so anyone can buy it on the ASX.
So your question here is really about portfolio rebalancing, Daniel. And so how our portfolios work, I mean, a growth portfolio and a high growth portfolio are always going to have lower levels of cash and higher levels of international equities and Australian equities. But then balanced and conservative. That's just the nature of the portfolios. And so how our portfolios, though, work are all on percentage bases. And so as one asset class increases as a percentage through performance or through the poor performance of all of the others, it grows as a percentage, and then it'll increase to the point where our investment committee says it's out of balance with our ideal asset allocation for that asset class. And so what that'll result in is transactions taking place, and we'll tip out of cash and into other assets, or out of other assets and into cash, or whatever is underweight. And so that's how the portfolios are managed. They're managed in line with a risk profile. So they're managed towards risk, not towards trying to position the portfolios for the best next attacking play, because basically if we did try to do that, we would never get it right.
No.
And the worrying thing about that is, if we did get it right, perhaps the next time we'd be more confident and go heavier with our weightings towards something, and inevitably at some point we'd get it wrong, and we could get it quite wrong, and your portfolios would end up well and truly behind the market. So these portfolios are designed to maintain a specific balance set by our investment committee, and then the transactions are made off that when the portfolios diverge from those set weightings by the investment committee. So that's where you'll see transactions take place to bring them back into weight. So we're not going to tip out of cash and into international equities or Australian equities and vice versa, because we see headwinds on the horizon, because those headwinds may never occur, and we'll be sitting there having poor future performance for you. So what we're going to do is, history tells us, stick to our passive approach, stick to our asset class weightings, and let the diversification of the portfolio generate returns over the long term for clients.
I think there's a second part to that question, which is what we get asked probably daily from a number of different people who are invested or thinking about investing. And it actually ties in that question and a couple others that we've just had come through. And it's the distinction between an actively managed investment and a passive one. So the InvestSMART diversified capped fee portfolios are passive. They're not trying to beat the market, the benchmark. They're trying to get the market return less any fees. And even on this growth page here, so I went to investment portfolios, I chose growth. If you scroll down to the performance chart, you'll see here a note, and it says the InvestSMART growth is benchmarked against Morningstar Australia Growth Target Allocation, and that actually has all the different percentage weightings inside it. So if there is a big change on that benchmark, the investment committee meets and they say, okay, we do need to follow that benchmark. We will adjust cash based on that. The one thing they're not doing is sitting there saying, as Mitchell has already alluded to, we foresee interest rates going up and up in the future. Let's change asset allocation to cash to a much bigger chunk to anticipate that, because it's guaranteed that'll eventually level off, and we'll probably go into another situation where there'll be lower interest rates, and we can't time the market. We don't know what's going to be happening in the next 12 months, 2 years, 100 years. But the other thing is too that Terence has asked a very good question here, asking what's the difference between things like the InvestSMART diversified portfolios, like the ethical growth, compared to the Intelligent Investor ethical share fund. On the website here, you can go up to Intelligent Investor, and you can actually go to funds, and you can see all the 4 different funds they've got, the latest being their new international select value fund. These are actively managed. So you're literally got a team of analysts, Nathan Bell, Gaurav Sodhi, behind the scenes, meeting daily, weekly, and talking about what they should invest in, why they shouldn't, why they should sell this. So there's actually a team working for you, and they're trying to beat the market.
And they're trying to beat the market in one specific asset class, which is predominantly Australian shares. They've got one fund that has international shares in it. So you're highly concentrated to Australian equities there. And as we showed in the table of ETFs that those diversified portfolios hold, if you're just investing in Australian shares, and that did 2.9% in the ASX 200 over the last 12 months, you're missing. Did it do? Yeah, I think it was 2.9. Am I right? Yeah, 2.9. You're missing out. You missed out on that 13.48% return of the international. So we blend these portfolios together to give a different risk-adjusted return, whereas the Intelligent Investor analysts are handpicking the best stocks that they can see in the Australian market and in one fund in the Australian and international market to try and outperform a benchmark. So 2 very different investment approaches that actually can be quite complementary. So if you are looking at the Intelligent Investor side of things that we have within our business and the InvestSMART side of things, many investors use both, and they do that in an approach called core and satellite. So I had one investor put it in very colourful terms, not colourful terms, but very entertaining terms, that he uses the InvestSMART portfolio to do all the boring investing that he knows he should do but doesn't want to do. So that's his core component. I think he's even on this webinar. So he uses the InvestSMART side of things to do all the, the passive, slow, long-term investing that he knows is a big positive for his portfolio, and he then goes out and handpicks those other things that he's really interested in, and that excite him. And that's a great way of having your cake and eating it too.
That's a good question here that ties in a little bit to that from Peter, just saying, when interest rates are high, would you recommend considering placing some funds in a high interest savings account? Obviously, we can't sit there and say you should do that, but it does come again down to that actively managed thing where, when you take them out, when, you're
taking on an active investment decision there, and when someone jumps out of the market, the hardest question is, when should I buy back into the market? Inevitably, I actually see most people then just sit on their hands because it never is the right time, or there's always something to keep them concerned. And then when those concerns are abated, the market's 15% higher. And so they think, oh, geez, I've missed out on the rally, and then they do nothing again. So that comes down, Peter, to we can't give any advice there, but your own
investment plan as well.
Your own investment plan, but also I'd say don't go jumping in and out of the market. You'll only end up costing yourself brokerage,
missing the dividends,
also costing yourself capital gains tax. So you have to weigh all that up to see perhaps it still would make sense to get that 4% return on cash, but you could be costing yourself a lot in the meantime, and you're also then costing yourself opportunity cost if the market does run away or have some positive performance. Tom, I think that brings us pretty much to the end of our online questions and the questions on your piece of paper here.
Yes.
So everyone, thank you very much for joining us. We'll be doing these webinars every single month. So please send through your questions. If you do have anything further or want to have a chat to us, invest@investsmart.com.au is the email address that Tom and we sit in that inbox along with our other colleagues. You can also jump on the online chat. You'll find myself, Tom, Daisy, Phoebe, and other Mitchell there answering your questions Monday to Friday. Outside of office hours, you'll also have a really useful bot, Dot the bot, who will help point you in the right direction within our answers in the help center. So once again, thank you for joining us, and we'll hopefully talk to you soon.
And we'll get the edited version of this up on the website, and definitely reach out if you've got feedback if you want to see something else added to this that you think would be a benefit. But thanks so much. Goodbye.